To talk more broadly about the market and the potential impact that we're seeing with this government shutdown, joining us now is Dale Smothers, the president and CEO of RDS Wealth Management. Dale, thank you for being with us this morning. I'd love to just start with your thoughts on market performance so far as we're now in the first few hours of this government shutdown.
Yeah, good to be with you, Marley. At the end of the day, I don't think that the market's going to concern itself much with the government shutdown. Historically, we see this to be the case. And for that reason, I don't think that we're going to have to worry as much about what's going on right now. And we can see that the market is moving higher today.
And Dale, one thing people do seem to be a bit worried about in our conversations before the actual shutdown, when it was just a potential, was the release of information, particularly the jobs report on Friday, and how imperative that is to the Fed. How concerned are you about us getting that data and when we might get that data?
Yeah, I'm not as concerned about the jobs report, to be honest with you. With us going into this most recent jobs report that we just saw, we know that the jobs report's going to come back weaker. And that is probably the key pressure point on the overall U.S. economy. We've got a lot of tailwinds still coming, though, and those are rate cuts. And the reason that we're getting these rate cuts is due to those jobs reports. This particular jobs report not being publicized is not as much a concern for us at this moment.
So if it's not a concern, how do you anticipate the Fed will react at the October meeting and then again at the December meeting?
I think we're going to see a 25 basis point rate cut. I do think that we're heading into a rate cutting season. This rate cutting season, some may argue, actually started last year around November. And we've seen this rate cut continue. It kind of paused here for the beginning of the year, of course, in 2025. But we've seen it restart, and it's all due to the labor uncertainties. This lack of data point is probably going to even yield a little bit more uncertainty in the Fed's view. And for that reason, I think we're going to see another 25 basis point cut just in case the market actually is a little bit weaker than what we had anticipated.
And the markets are pricing in that cut for October and also mostly pricing in that one for December. But one thing that could impact it is this AI spend. We've seen this AI spend story. So I want to pivot to the rally and the boost the market has been getting from this infrastructure spend. And, any concerns that you have there? Are you a part of the AI play, I guess, is question one. And two, do you have any concerns about it preventing the rally from going higher at some point if the bubble were to pop or see a pullback?
I think that the market right now is not really asking many questions that probably need to be asked. And I don't see that probably being asked in the next 2 to 3 months. I think we're going to finish higher in the year because of this AI infrastructure build out. Starting in 2026, we'll probably have more questions about, okay, now we're starting a new year. Let's see what's going on with these $1 trillion spending projects, and when will they ever be favorable? So what I'm thinking right now is that the market is likely to finish higher because of this AI infrastructure spend, as well as the rate cuts that we've just discussed. But when we get into 2026, I do think that there will be people who are taking a pause to look at the valuations of these AI-driven companies, and that may pose a little bit of a headwind for the market as a whole.
So with the environment and the market potentially finishing higher on the year and no one asking those questions at least through 2026 about AI spend, is your position that right now this environment favors staying invested even if we do see some volatility?
Certainly. I think we stay invested, we stay optimistic, we stay patient even, and that volatility will come. And as we see these pullbacks, buying really good names at this point is what I would recommend. Buying those names, holding those names for the long run. AI is probably a little bit overbought at this moment, but there are some names specifically that you can find a little bit of a discount in that aren't nearly as bid up as high. And I believe that we should be buying those names when we see those opportunities present themselves.
And what are some of those names, Dale?
Yeah, so we've got Apple and Amazon on our watch list for sure. Apple has recently went up. We have been preaching Apple for the last 6 months, specifically because its AI build out wasn't quite as clear as what we would have liked to have seen. Now that we've got some clarity around that, we believe that Apple has hit a really good price point where it's at today, but still got some room to run up. Amazon's another one, the Mag 7. It has certainly been behind the Mag 7. Amazon is seeing, of course, its cloud-based service subscriptions are going very well. We think that Amazon is likely got a lot of room up as well inside of this particular name. I'd be focusing on those two specifically if we're talking about the AI trade.
All right, and then outside of the AI trade, what are your thoughts on something like a CoreWeave? They're making a headline every day with their partnerships that they're making, huge company names.
Sure, and this is one of those that you may want to reevaluate come 2026 and say, is it really worth what it's priced at? But right now, I am a big believer in the CoreWeave momentum. This is a momentum trade for us. We believe in CoreWeave. It is an AI name still. It's the data center behind it all. It really trains the AI models. AI is here, and it is likely to stay for the next 3 to 6 months, at least, if not more. I don't know exactly what inning we're in, but while we're playing the game of AI, I would recommend looking at a name like CoreWeave and its momentum that it is carrying into the end of the year.
I love the constant sports analogies about the AI trade and what inning we're in. But outside of AI, is there anything else that you like, anywhere else you favor that's completely unrelated?
Completely unrelated. Let's go to gold, because this underlying commodity is going to benefit a name like GLD. I'm a big buyer right now of GLD. We've got higher demand from government and institutions. This uncertainty will only fuel the appreciation of the underlying commodity itself, and ETFs like GLD are likely to benefit. I also like Royal Caribbean in a lowering rate environment. Royal Caribbean likely will be a benefactor from that, and it is one of the leading names in leisure stocks. I would be looking at those specifically. And let's transition real quickly to EV. I'm not a huge buyer of EV right now because of the administration's stance on electronic vehicles. But if we're going to put some money into electronic vehicles, be looking for an opportunity to buy Tesla with the EV mandate, or the EV subsidy rather, recently sunsetting. I think you might see an opportunity to get into a name like Tesla, which is the king of the road for electronic vehicles. I would be buying that if we see a pretty steep pullback, because now that we've got Elon Musk's focus into that company, I think it's got a lot of room to run.
Yeah, and not a bad time to be invested in gold right now. At the top of the show, had crossed the $3,900 mark for another all-time high. Dale, thank you for being with us today. That's Dale Smothers, the president and CEO of RDS Wealth Management.